Well, hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to Chart This with Dave Keller. Kind of a different format today, and most likely all of next week. I'm on the road, actually coming to you from the East Coast today, not the West Coast, here in Boston, heading up to New Hampshire tomorrow morning for a music camp for next week, where a bunch of composers and performers and arrangers all get together up in the hills of New Hampshire, perform, create, experiment. It's a great creative week. I've done it once before and it was just a life-changing experience. I'm super excited to go back there. I'm also excited to take a few moments every day and give a quick market update. So it'll probably be an abbreviated market update with sort of this kind of format. But today, a little different. We're going to do a mailbag, answering some of the questions we received from all of you guys this week. So as a reminder, we will jump to the questions here in a moment after a brief market update. Hey, let's just get to it. All right. So as we go here, and sorry, I'm switching between a couple screens here. So hopefully this all goes pretty smoothly. But as we're looking at the markets today, obviously a risk off move today. The events in the Middle East really starting to expand in scope, with Israel and Iran now drawn into a conflict together. The U.S. now, unfortunately, I feel like is certainly, in some small way or maybe large way over time is involved as well. We'll see what actually happens. For now, it seems to be relatively concentrated. You're seeing some initial reactions, certainly with crude oil prices and hard assets, commodities spiking higher today, and risk assets rotating lower. We'll see what happens over the weekend and then into next week. Some interesting things on the charts, and particularly a bearish divergence I definitely will remind you of here as we get to the chart of the S&P. But overall, the S&P down 1.1%. That takes us below 6,000 to finish the week at 5977. The Dow down 1.8%. The Nasdaq Composite down 1.3%. Mid caps, small caps, all down today. The S&P 600, like the other major indexes, finished near its lows for the day, down almost 2% today. The VIX did move above the 20 level. And as a reminder, right, what we've talked about this week is, market innocent until proven guilty, right? Trend is higher highs, higher lows. That's all good. So what would we look for that would tell us the trend is no longer good? Well, we look for changes, right? And as we talk about, we look for changes in breadth. We look for changes in momentum. We look for changes in leadership. And I would argue, the volatility that we're seeing is certainly probably a change in sentiment. I would say probably more than anything, but it certainly speaks to the a shift of sorts in terms of the price action and the expectations for future price action. One of the things we've talked about is a VIX below 20 is a low volatility environment. There's just not much to be worried about. I mean, the chances of the market going significantly down without the VIX going above 20 is minimal, if not zero, because markets just don't calmly and quietly and rationally drift lower. They usually roll over very, very quickly, because once people start to feel an initial loss, they start to panic and they start to sell more, and that just creates more and more of a feedback loop to the downside. So if VIX below 20, it just means there's not much to worry about, right? Even if there's a pullback, it's probably not that big of a deal because the volatility is still low. Friday's session, we pushed lower on stocks. We spiked higher on the VIX. VIX pushes above 20 on Friday's close. We will see what happens at the beginning of next week. We'll see what happens with additional headlines, but I would say the VIX remaining above 20 into next week is not a great sign for the bulls. I think that would pretty much most likely suggest at least a tactical pullback of some sort here, which again makes a lot of sense after the run higher that we've seen in risk assets over the last 2 months. Looking at interest rates, bonds actually sold off today. So here's the TLT, sold off for much of the day. The last 2 hours of trading, the TLT actually pushed higher, but the damage had been done. The TLT was down 1%. Interest rates generally moved higher today. So the 10-year yield up to 4.42. The long bond yield not quite to 5%, but getting close at 4.9%. The 5-year point right around 4.02. The dollar index up slightly, right about 1/3%, 0.3%, we'll call it. Had spiked higher earlier in the day and then settled in a bit. Big moves in the commodity space. Gold actually up 1.3%. Crude oil, of course, the big mover. Makes sense when you have a conflict in the Middle East that certainly appears to be drawing in more actors into the conflict, usually means crude oil prices start to push higher. There's just and again, even though there will be a lot of guarantees from Saudis and others saying they will add supply to address it, doesn't matter when people get nervous about conditions in oil producing regions of the world. Crude oil prices usually spike, and Brent crude popped higher today as well. Silver prices, copper prices noticeably were actually lower, something to monitor. Bitcoin, honestly, not as bad as it could have been. If you look during the equity trading session, Bitcoin was actually trending higher for most of that time. So stocks were selling off, Bitcoin pushing higher. It's currently about flat for the last but again, the 24-hour period just stopped here. So that's just saying as of that's just saying from that last blip. So the last 24 hours have actually been pretty strong after Bitcoin got down to around 103,000, currently just above 106,000. Still remain fairly constructive on the chart of Bitcoin long term for sure. And I do own Bitcoin and Ethereum in my own portfolios. Looking at the 11 S&P sectors, you can see energy pushing higher today, 1.7%. All other 10 sectors were down. Healthcare and utilities were second and third on the list, both down about 0.5%. Those are, two of the, sort of classic defensive sectors, followed by real estate, another classic defensive sector. On the downside, financials down 2%. Technology, second from the bottom, down 1.4%. Consumer staples down 1.2%. So offense outperformed defense based on our simple comparison of the XLY to the XLP. Check out the breadth, though. The breadth was not good. And as we mentioned before, right, three things we look for are, changes in price, changes in breadth, changes in momentum. And I would say this speaks to the changes in breadth that we've experienced here through the course of this week, but especially on Friday. This was an 86% down day for the S&P large cap index, an 80% down day for the New York Stock Exchange. Almost 90% of the small cap S&P 600 index members were down. So almost everything was down today. This is a big sort of washout pullback kind of day. There were random names that were up. It's going to be a lot of energy. It's even some renewable energy like solar names like First Solar. Oracle, coming off of an earnings win this week, continue to push higher today. But those are very much the outliers. Most stocks struggled today. Gold stocks up today, by the way. Tesla up 2%. I mean, talk about a completely different vibe here. Tesla's been struggling recently, but then pops higher while other things were down. On the downside, Broadcom and Nvidia, two of the big technology names, down over 2%. Meta down 1.5%. Apple continued to struggle and continue to underperform. So looking here, I think a key item to pay attention to going into next week, and we have a question on bearish divergences coming up. I will tell you, I wrote an article just earlier today about bearish divergences and what I've now seen for the S&P 500. Bit of a history lesson. I'll show you what some of the previous major market tops post-COVID have looked like. They've all featured a bearish momentum divergence, which happens to be what I think we might be seeing right about now. This gets more and more valid the more we pull back next week. This is assuming that we get more of a pullback after this initial drop off of Wednesday's high around 60.50. What's happened now, if we continue to pull back, that makes a clear higher pattern in price, a clear lower pattern in RSI. Higher prices, weaker momentum. That's a bearish divergence. When we talk about changes in momentum, I think we might be seeing that right about now. A lot of the long-term breadth indicators like stocks above their 50-day moving average, stocks above their 200-day moving average, the bullish percent index, nowhere near danger zones just yet. To be clear, this is one big down day after making a new closing high off of the April low. So it's still pretty early on, but I'm definitely starting to see some of those changes. I would say defensive sectors, something to watch for sure next week to see if they continue to outperform in the way that we've started to see here. All right, that'll do it for the market recap. Let's get to some of the thoughtful questions you guys have been sending in. As always, when we're live streaming, just drop questions wherever you're watching the live stream on X, on LinkedIn, on Facebook, on YouTube, wherever you can put in a comment, just drop your question there. We gather all of those. The ones we don't get to live, we put them in a mailbag. These are 6 of the questions that I hand selected that we received this week that I thought would be great to spend a little bit of a time on. So let's get to it. Question number 1, Dave, is it possible to use the PPO histogram to judge overbought and oversold conditions? I mean, kind of, right? The answer, that's a kind of, I would say, overall. You could, I think. Is it my ideal way to do it? It is not. But could you do something like that? I think so. Here's what we'll do. I have a chart of Home Depot here, and sorry, I meant to highlight the mouse. We've got RSI, and then I'm going to change the bottom panel from performance to PPO. And same thing, you could do MACD. They're very, very similar. But the idea with the PPO indicator is it is a trend following indicator driven by moving averages, right? So you have this black line is called the PPO line. That's the spread between the 12 and 26 day exponential moving averages. You then have a red line, which is a 9-day moving average of the PPO line. So it's a classic technical indicator approach where you have the main indicator and then you lag that with another moving average and just look for when they cross above or below each other. Stochastics looks like that. Some other indicators you may be familiar with. But you're actually asking about this histogram here, which is the blue histogram, which is literally just the difference from the PPO line to the signal line. Here's the idea, right? I'm going to look at kind of this period. Just brought up this example randomly. I haven't really looked at this before now, but this is the chart of Home Depot. Home Depot rallies in September and October of 2024. We can see that the histogram is going up here in September as we're making new swing highs. We actually make a new 52-week high in September and October. The PPO indicator is still bullish, but you can see the histogram starts to slope downwards. So that usually happens toward the end. And I would say with the histogram, it's less overbought and oversold conditions because, as you can see, the variety, there's too much variety, right? It's not like peaks consistently have a PPO histogram value of a certain level, or the same with valleys. It's very hit or miss. So I found divergences are much more helpful. When you see a market going higher and the PPO histogram starts to slope downwards, kind of like an early warning sign. It's a red flag that we might be getting a sell signal soon. The sell signal is when the PPO line crosses down through the signal line. That usually only comes after the top has already occurred, because the PPO or the MACD is a lagging indicator based on moving averages. So until the price turns over, you're not going to get a sell signal. So the PPO histogram is used to try to anticipate turns in the PPO indicator itself. After that sell signal on October, we can see we sold off for about 3 weeks to a low in early November. You can see that the PPO line is still well below the signal line, but look at how the histogram starts to slope higher right about here. So just before we start to rally, that's where the histogram is telling you, oop, we might be right around a low. And then the signals there when you actually get the buy signal. So the way that I've seen people actually use this is you think of a trade in two parts, right? You have the more aggressive signal, which would be the divergence. You have the more conformational or lagging signal when you actually get the PPO signal. So maybe you take half a position on the divergence and then you complete it on the lagging signal. That's one way I've seen people try to use the histogram. But would I use it for overbought, oversold? I wouldn't think of it that way. I would use RSI and just use different settings for the RSI if you find like it's too sensitive or not sensitive enough. In my experience, that's a better way of thinking about oversold and overbought conditions in particular. Great question there. And thanks for asking about the PPO indicator. On stock charts, by the way, and on other platforms, you can scan on PPO histogram levels and changes and all of that too. Do you see a typical pattern either leading up to a recession and or of the conduct of the recession itself, or is each one individual with no real pattern? We're looking for consistent signs to determine a recession. So recessions are tricky, okay? And this is how I will start. Recessions are tricky, and I will tell you why. The definition of a recession, right, is multiple quarters of a decline in GDP, right, like a shrinking of GDP, the change going down, and so as a result, 2 consecutive quarters means that's a 6-month period, and GDP numbers get reported on a lag. So if it is a recession today, let's say there's a recession happening today, it is very realistic that we won't know for sure. Economists won't be able to look back and say, oh, yeah, that was a recession back there in June. They won't be able to tell us for months from now. I mean, months. Way after the market has probably reacted in some horrible way to the recession, and companies are starting to struggle with the recessionary pressures. The recession actually isn't declared until way after the fact. And I think it's a great example of the unfortunate, very significant lag in most economic data, right? When stuff is reported, it's way old news. And then also remember that a lot of times previous reports are updated, right? They'll have revised numbers for the previous month or the previous quarter. So it's such a laggy set of data. And so trying to make projections based on data that's months in the rearview mirror doesn't make a ton of sense to me. So I will tell you that looking at economic data is usually not really helpful, because by the time it actually tells you it's a recession, you probably missed any benefit of knowing that was a recession. So what can we do? Here's what I would suggest. You look at the yield curve, and the most consistent indicator I've seen, and I should have brought this up before I said this because I'm trying to think of which. There's a couple chart lists where this actually might be. I think it's here. There's some chart I have, and if you see it, I hope you can see it. It's a 10-year treasury yield. Is it this one? 2s and 10s? No. I have a chart, and I'm going to spend another like 30 seconds trying to find this because it's a really good one. But it basically looks at, it might be here. It actually looks at the shape of the yield curve. Here we go. Maybe? No. Oh, I thought that was going to be it. Okay, we keep looking. I'm so sorry. I should have brought this up ahead of time. I have a chart somewhere, and if I can find it, I will put a link to it in the description. But it basically looks at, here we go, yield curve 2s and 10s with the session. I knew I would find it. Just took some time here. This, and I haven't updated this in a while, so it might actually be more current at this point, but I don't think so. This is the 2s to 10 spread. So common way of looking at the shape of the yield curve, right? When you have a yield curve which goes from short duration, like 1 month, 3 month, paper down on the short end, all the way down to long duration bonds, 20-year, 30-year bonds, right? So that chart, that plot of the yield on the different points of the different durations is called the yield curve, right? And how that progresses. When the economy is in good shape, when things are good, the yield curve has a normal shape, meaning it generally inclines as you go further out, because the idea is there's optimism that the economy is going to grow down the road. And so we have higher rates projected down the road, basically. And we're willing to, benefit from that longer duration and tie up our money a little bit longer. When investors are less optimistic about future economic growth, you have an inverted yield curve where the short end is higher than the long end, because people aren't really excited to tie in their money down the road because they don't think the economy is looking very good. So they'd rather keep things short term or go into other things. And so as a result, the yield curve gets inverted. So this plot on the top is the difference between the 10-year point minus the 2-year point. If it's below this purple zero line, that means the yield curve is inverted. If it's above the zero line, the yield curve has a normal shape. When it's right around zero, you call it a flat yield curve, where basically the durations are pretty even, also not great. So one of the best predictors of a recession is the inverted yield curve. Go back with me to like the late 80s, 1990. We have an inverted yield curve in 89 and 90. It finally becomes normal shaped. We have a recession. In 2000, 2001, we had an inverted yield curve, which turned back positive right at the beginning of 2001. The yield curve took on a more normal shape. There was a recession. We sold off. And this is the S&P at the bottom. You can see it usually sells off during the recession. In 2006 and 2007, we had an inverted yield curve. The yield curve took on the normal shape. That's where the red vertical line is. You can see the stock market sold off soon after. The shaded area represents the recession. This has happened with every major recession going back to the 1980s, which is why we highlight it here. So, the yield curve was significantly inverted in 2002, 2003, 2004, and turned back to a normal shape at toward the end of 2024. So, and again, remember, it's not perfect, right? So it's not like the timing is exact. So, right, it might take a normal shape, and then 6 months, 3 months later, that's when a recession actually has started. So it's hard to tell in the heat of it. But this chart would imply, given the fact that the yield curve was inverted for an extended period of time, usually means a recession is coming soon after. Now, what always happens in this environment is people will tell you that this is different and it doesn't count this time and the yield curve was inverted, but it's for some exogenous reason that doesn't matter. I'm a big fan of charts that have consistent patterns. I think that's one of the best predictors you have, which is an inverted yield curve. And again, that's because investors that invest in debt are not optimistic about future economic growth, and that usually means we're heading to a recession. Next question. How much risk do you think US dollar fluctuations pose for European investors in the US market? Should the nominal value of US stocks move with dollar value changes, or is it a risk that should be hedged? Oh, well, that is a nuanced question right there, my friend. I really appreciate what you asked there. So there's kind of three different questions embedded here, and I'll spend a brief moment on each one. How much risk do I think US dollar fluctuations pose for European investors in the US market? I would say significant. And that is a risk for European investors for the US market. That's a risk for US investors in any other market. Anytime you invest in anything that's outside of your home currency, that currency differential can be a significant driver of your returns. I just interviewed George Noble of longtime Fidelity fund manager, longtime hedge fund manager, an incredibly knowledgeable man about investing and money management and the history of both. And we talked about this because he ran the Fidelity Overseas Fund in the mid 1980s. And he talked about how, as an international fund manager, as a US based investor, not denominated in US dollars, but investing in emerging markets and developed Asia and developed Europe, he said it was all a macro call. Like, you're trying to find good companies for sure, trying to find good stocks, but the strength or weakness of the dollar absolutely defined your returns on any given year, because it was such a big, would create these huge swings, right? So if you remember, if you own a stock and the stock goes up 10%, but the currency goes down 20% on a relative basis, you've lost money on a stock that went up, because you gained on the stock, but you gave it all back and more on the fact that the currency changed. And so it's a significant risk. So if you're a European-based investor, I would say the weakness in the dollar should be top of mind, and understanding that should be key. So your next question: should the nominal value of U.S. stocks move with? And I'm leaving this up here because this is a tricky one. Should the nominal value, meaning like the price value of U.S. stocks, move with the dollar value changes? No. Because a U.S. company traded in U.S. dollars will have nothing to do with the conversion, right? The conversion is separate. So what you basically have to remember is, if you're in Europe, you convert your euros to dollars, you buy a U.S. stock, the stock moves, the dollar value moves relative to the euro, then you sell the stock and convert your dollars back to euro. And so that change in currencies on both sides is what is impacting your return, because the value of the dollar euro most likely is different from one to the other. So the nominal value of U.S. stocks have nothing to do with the change in the dollar. Now, having said that, will the change in the dollar affect companies? And then it would affect their stock price. Yeah, so it's not a direct currency impact, but if you're a big multinational company like Apple, and you get a bunch of revenues from outside the US, or you have a bunch of employees outside the US that you have to pay in a different currency, that currency differential can be a huge factor. So it's a big factor for big multinational companies that have a lot of non-US operations. The strength or weakness in the dollar can definitely impact their bottom line, because they have to plan for the dollar and adjust for it, and are impacted by it for sure. Is it a risk that should be hedged? Is your third question. This is an entire hour could be spent on this one questionnaire. I feel like it's a webcast we're going to make at some point. Is it a risk that should be hedged? So that is a source of great debate. And so the short answer, I would say, is most people would say yes, it should be addressed. Should it be hedged away? Maybe. Should you think of the dollar strength or weakness as part of your investment thesis? I'm buying a good company, and I think the dollar is going to weaken, and so that's going to help actually increase my return. So I'm going to hopefully get stock price appreciation and a currency that's going to improve in my favor. That's either part of your investment thesis, that change in the currency value, or if you don't want to make a currency bet, you just want to bet on this company doing better, then you could hedge it with futures or something else. ETFs, right? Something to sort of hedge away the currency differential. Boy, that's a meaty question right there. That's the best I can do. And when I'm taking one of six that's only one of six that I'm going through, so I can't hit everything. But I hope that answers your question. I would encourage you to listen to that interview with George Noble. By the way, it was pretty awesome. By the way, just as a quick comment before we continue, I do want to let you know Seeking Alpha has their summer sale happening right now. If you use my link, marketmisbehavior.com/seeking alpha, you get to a special page where you get 20% off your membership. That's good for the Seeking Alpha premium membership. Also, Alpha Picks. They have a combined package. It'll give you 20% off all those and also include a 7-day free trial to the Seeking Alpha premium service as well. There's an event coming up. You can see it on the top of the Seeking Alpha page coming up on June 17th. Stephen Kress, who I actually interviewed for my podcast earlier this year, he runs the quantitative research team at Seeking Alpha. He manages their quant models and created them from scratch. He will be giving a second half of the year market outlook, highlighting some of the names that score well using their quant methodology that he will go through with you. You can access all of that only as a Seeking Alpha premium member. They have a sale going on right now just for the next couple weeks. I would encourage you to go to marketmisbehavior.com/seeking alpha. If you use my link, you get a better deal. It doesn't cost you anything more. Helps me make Market Misbehavior awesome. I'd appreciate it. Check it out. Next question. Do you feel that getting your CMT is helpful for breaking into the industry? I love that question so much. I swear I didn't plant that. That was one that just naturally came. For sure. I got involved with the CMT Association early on in my career. I kind of realized I wanted to do technical analysis. I had signed up for the CFA exam. And I absolutely hated it. I hated studying for it. I hated taking it. I did not pass level 1. And I mean, I knew going into it, I'm not an accountant. I don't enjoy looking at financial statements. I absolutely I can't tell you how much I did not enjoy that. And I remember talking to one of my mentors at Bloomberg at the time and said, I'm not excited about the CFA. He's like, dude, you want to do technical analysis, you need to get a CMT. And he pointed me to the website of the MTA, which is now the Market Technicians Association, which is now known as the CMT Association. Changed my life in so many ways. It changed the way that I think about investing, how I think about structuring a trade, how I think about analyzing charts in a systematic way. I would say my process before the CMT exams was very sporadic and inconsistent. My process afterwards was thoughtful and deliberate and consistent. It was like a checklist, and the CMT exams and all the studying helped me do it. So I would say that was big. And also just getting involved with the organization, meeting, volunteering. I served on the board. I was the president of the organization for a number of years. I've served in a number of different roles and actually just recently agreed to help in the effort to relaunch chapters in North and South America, which we're just getting started with here going into the fall. So super excited to do all that. So I can't tell you enough that I think it's a fantastic organization. What I also appreciate very much about the CMT Association, the ethical standards. One of the things when you have the CMT, you every year agree to ethical standards. And I would tell you that is unfortunately way too rare in the financial industry, but that's why things like the CMT Association, the CFA, and other professional designations matter, because we all as professionals, as a group, agree to monitor each other, agree to submit everything we do for critique, and we agree to abide by certain ethical principles. And I find that incredibly important to, in an age where anyone can get a YouTube channel and tell you about charts. I'm a big fan of CMTs that have agreed to do so ethically and respectfully and in ways that we think will help people make better decisions. So big fan. You can find more information at cmtassociation.org. I think the experience is fantastic. Arguably most professional moves that I've made be after 2002 had in some way to do with either taking the exams, getting to know people and networking through the CMT and going to events. Big fan, highly recommend, A+. Easier question. Can you scan for bearish divergences? I mentioned the article that I wrote. I would encourage you to check that out. It's this one just posted on the articles page on stock charts. Even if you're not a stock charts member, you can see that. But I'll highlight some of the historical market tops, what divergences mean, and why I think it's important to be very aware of here in the month of June 2025. But your question is, can you scan for it? So the quick answer is no, but the longer answer is yes, in a way. So kinda, I think kinda is the official answer that I would do. I don't have a scan pre-built that does it. So I'm not going to try too hard on this one to just do it live, but here's what I would do. This might take a little bit more work. Maybe I'll work this up and then share this in an article next week or something. There are two pieces to that, right? So to look for divergence, so you can't just say I want divergences. That's not something that's captured because it's really hard because it's a visual analysis, right? When two things are different, but you could look at the slope of the price and the slope of an indicator. You could look at the change in the price and the change in the indicator. It's not going to be perfect. You're not actually searching for divergences. You're just looking for things where the price has gone up and divergent and the indicator has gone down. So you would need to use the building blocks and say, actually look at the RSI value and say the RSI value today is lower than it was 1 month ago or 2 months ago. And that time frame is why it's a little weird, because the divergences may take 3 weeks. They could take 3 months, depending on it. So it's hard to generalize. But if I would take a shot at that on stock charts, which is what comes to mind, and I'd love to know if anyone knows if other platforms do this, I'd be interested to hear about it. But I would basically scan on price going up. So you would say, the current price basically now versus 1 month ago is higher. The RSI now versus 1 month ago is lower. I would start there. It's probably not going to be perfect, but at least we'll give you a working list of charts to go through. That's what I would do. It's an interesting thought, though. I hadn't really thought about doing that. It's traditionally very tough to scan for because it is a very visual form, and things that are more statistical are very easy to code, very easy for a computer to understand. Image recognition is getting pretty good, so I wouldn't be surprised if there is some platform somewhere that allows you to say, show me bearish divergences, and it just does it, but not one that I know of. I think you have to back into it in a somewhat challenging way. So that's a tough ask right there. Final question. XLK has been bumping up against resistance at the 242 area. When do you decide when it will not overcome that long time chart resistance? XLK 242. Let's take a look. Yes, boy, it's hit the ceiling a number of times here, right? We'll zoom in just a little bit, and you can see how many times we've hit this same kind of 242 level. Really, I mean, almost going back to that July high from last summer. That was a little below there, but I mean, really, end of last year, beginning of this year, we consistently bump against there. So it's been bumping up a bunch. When do you decide when it will not overcome? I mean, it's an interesting question, interesting way of phrasing it, by the way. So I would think of it this way, right? I mean, at this point, it's a clear level of resistance, what we call a supply area, right? This is a level where sellers are coming in. This is a level where buyers are exhausted. We've been struggling to get over 242. So I will tell you, as we rally, would I expect at least some resistance here when we round trip back to 242? 100%, absolutely. Would be surprised if we didn't have at least some pullback from that level. Alan Shaw, the late Alan Shaw, who ran the technical research department at Smith Barney for a number of years, kind of in the golden age of big brokerage technical analysis departments. He had a huge team, people like Louise Yamada, Ron Dano, Jonathan Lynn, all worked with Alan Shaw, if I remember right. Definitely Louise and I talked about Alan, and I've met Alan, got to know him a bit before he passed away. I mean, just a really fantastic technician, and inspired many in the industry to learn more about and appreciate the charts, which I'm thankful for. He would say the bigger the base, the higher in space. The more that a price tests a certain level, the more meaningful it is when it finally breaks out. But I think, to your question, for me, it's less about how long do you wait before you go find something else. I would just say you wait, right? You don't really take a shot until we break out. This is why big base breakouts are so important, right? A basing pattern is sideways. A breakout is when finally we break above resistance, right? And so think about what that means. If the XLK finally pushes above 242 to 245 to 250 to 260, to me, that would say something's different here, right? There's a way more optimism than we've seen here in quite some time. That's the kind of thing I probably want to get behind and follow higher. So I don't, for me, it's less about how much time do you give that trade to evolve, but more you set your alert at that entry point, and then you just wait. And if it never comes, it never comes. Then you find other things to do with it. But I would say again, jumping ahead of it is where things can get very, very dangerous. Folks, that'll do it for today. Thanks so much for following my work. As always, I appreciate you guys so much watching live, asking questions, making this a lot of fun to do. I've heard so much great feedback and questions from you guys over time, and I really appreciate all of it. Hope you found that this Q&A session today, this mailbag evening was helpful for you. We'll do an adjusted publishing schedule next week. This kind of, hope you like this look and feel on my laptop. This is what we'll do next week, but I hope it just gives you a quick update on what I'm seeing and what I'm thinking when I have a chance to review the charts. And then the week after next, we'll be back in Redmond, Washington, full go. In the meantime, have a fantastic weekend. Be safe, be well wherever you're at. And remember, it's always a good time to own good charts. Take care, folks.